All right, the first half of 2022 is in, and it's over. Thank goodness. We got the NASDAQ finishing down 30, S&P down 20, aggregate bonds down 10. Brutal. Worst start in the last 52 years, back in Jeff's college days. Anyway, let's talk about it here, and what are investors to do? Why was it so brutal, and what do we have to look forward to ahead of us? All right, so here we are, Presidio Perspective. Let's get it going. All right, Jeff, I just, capped it off on the headlines here. So 2022, first half is in. Let's do a little recap for everybody. But I want to talk about, what did Governor Powell say this week, Fed Chair Powell say this week? Talk about, this recession. Are we in one? Is it coming? When is it coming? How bad is it going to be? What should investors be bracing themselves for? And what should they do right now? What can they do? Of course, what should they not do? We always talk about, but what can they do? And what are some opportunities that we can see and look in our portfolio, for this second half and into 2023? So let's start off with a recap of 2022, or the first half anyway.
It wasn't pretty.
No.
So let's get the bad news out of the way. I mean, we've all lived through it, but NASDAQ year to date, so the end of June was 6 months, down 30%. S&P down 20.
And then NASDAQ started peeling back in November, right? S&P kind of hit its high, I think June 2nd or 3rd. So year to
January.
date. Yeah.
January 2nd. Yep.
So NASDAQ's peak to trough, probably down 39, maybe more. Okay.
S&P down 20% year to date.
Yeah.
And the bond index, the U.S. Ag bond index, down about 10.5. And that's not supposed to happen, is it? Bonds are supposed to provide a ballast to the portfolio.
Yeah.
And there are reasons why that didn't happen.
Well, they go down when interest rates go up.
Right, exactly.
So,
but all told.
So then for equities, it was the worst first half in 52 years.
Yeah.
So what, we're going back to 1970?
Yeah.
That's the first worst half that we had.
Yeah.
And
we've had some pretty bad periods.
Yeah.
From 1970 to now. And some of those were economically worse than we're in now, in my opinion. But it's been...
I mean, put this in perspective. The worst first 6 months in 52 years. And you just think of all the stuff. We could talk about that wall of worry that we're climbing, that wall of worry that people have. 2 years ago, we had COVID. We had the pandemic, and the whole globe shut down for business. This year's worse. 2 years later. Who saw that coming? Pretty difficult to forecast these things.
Yeah.
Right. If I was going to bet on the end of the world and I had to pick a year of 2020 or 2022, it's probably the former, right?
Definitely.
So, however, we know not to do that. So the Fed funds rate is sitting now at what, 175?
Right.
And we started the year where?
About 25 basis points, about 1/4%.
Okay. I mean, we're at zero. And
we're
so
0 to 25. It comes in a range. But,
right.
Yeah.
Okay. And so now we're up to 175. So that's a pretty big move. I mean,
it's drastic.
Biggest.
It's the most aggressive Fed rate hikes in memory.
Yeah. Well, going back for the last 40 years. Of course, we had the Volcker period, right, of 82 that is being talked about all the time. So why was it so bad, Jeff?
It's all about inflation.
Number one, inflation, for sure.
Yeah.
And that's something that we know about. I mean, inflation... Should we be that surprised? What causes inflation? Too much money chasing too few goods. What happened in 2020 and 2021? We just printed money. Trillions and trillions of dollars. Just handing it out to businesses, giving it to businesses that, here's PPP loans, and those business owners took that check and walked, didn't give it to anybody.
Right.
People quit their jobs or got fired or went on unemployment. Here you go. We'll give you more money. I've talked to plenty of people that didn't go get a job because their unemployment was so great.
Right.
So, okay, let's just say you did what you think you had to do during the pandemic, maybe a little overboard. Forget that debate. Let's just talk about what happened. We printed money. We gave it to people. And so that's creating a lot of demand.
Right.
What creates supply? Productivity. People didn't work. Businesses shut down, right?
Yep.
On top of that, we have an administration going against fossil fuels and producing energy. And so, that's just what happened, is that we printed money and didn't produce anything. And so you have less supply, more demand, that causes prices to rise. And that's what they call inflation. So now what do we do about it?
It's what the Fed does about it, right?
Yeah.
And we talk about the Fed, but what is it that they do? Well, with inflation, they're committed to what's called price stability. And these are unstable times. Prices are rising faster than the economy can withstand. And so how do they do it? They change their interest rate policy when the economy overheats and there's too much demand.
So I think I think a lot of people hear that the Fed is raising interest rates, that we're going through a rate tightening cycle, that we have a hawkish Fed. These are kind of a lot of the buzzwords that are out there. I don't think a lot of people understand necessarily what this is supposed to do to inflation. How is the Fed, the limited tools that they have, so A, what are they doing? And B, how does that bring down inflation? So A, what are they doing?
They're reducing their balance sheet and they are increasing interest rates, raising interest rates.
Okay, so raising interest rates. How does that bring down inflation?
It is supposed to reduce demand.
How?
By increasing the cost of capital.
Okay, so now people have to pay more when they borrow money.
Right.
So they are going to borrow less money. What happens when people borrow money? That's a lot of things. Like borrowing money is taking money out of the bank and putting it into the economy.
Right.
Which first comes from the Fed to got to the bank, or the printing press. But when I'm borrowing money, okay, I'm buying a house, I'm starting a business, I'm buying a dress, I'm paying for airline tickets on credit cards and mortgages and loans and SBA loans, what have you. So when you borrow money, that's like, what does that mean? That means money is going into the economy to buy something.
Right.
Anytime somebody borrows money, money is going into the economy to buy something. And when the cost of that borrowing is cheap, everyone does it.
Right.
I'm going to go buy homes. I'm going to buy cars. I'm going to have zero interest for 12 months on my credit card. I could go buy. Right?
But why does the Fed allow that to happen? And when
that's to stimulate the economy.
Right.
So I think when we're saying that the borrowing costs go up, like who does that affect? Right? And so a lot of all this buying is done on leverage and on debt. And all of a sudden, everything is going to cost more.
Right.
And if people have looked at buying a home and they've looked at mortgages recently, it costs more. You might not want to buy it.
Right.
Your credit cards are going to cost more.
Right.
Your business loans are going to cost more. Businesses are going to pay more interest.
Right.
So if we just kind of go through these things and we say, okay, if the Fed is raising interest rates and the consumer has to, pay more on credit cards, or their interest coverage on their credit cards is going up, they have less money to go buy stuff, even if they're just servicing their debt, let alone wanting to go buy new stuff.
Right.
And if you look at the real estate homeowners and real estate investors, if it's going to cost them more to buy the home, they can afford less.
Right.
So what is that going to do to the demand? Bring it down. What does that do to the price? Brings it down. If businesses have to pay more on their loans, right, then they have less money to put into research and development, plants, equipment, new technology, and hiring, or dividends and share buybacks.
Yep.
I have a thumb out here. What's the last one that I have? Would I go through autos, maybe? Auto loans?
Well, you didn't mention auto loans.
Yeah, well, that's another one, right?
Right.
So, the higher interest rates, but then also, hey, I got one for this thumb. Higher interest rates mean that I could earn money that sits in the bank.
Right.
And if I could earn money by keeping my cash in the bank versus having it be worthless, or worth less, then, maybe I will be more thoughtful of what I go to do to invest this money.
Right. So it increases the desire to save. But the Fed, what was what was going on with the Fed early on when they talked about inflation being transitory? What's the big issue we've been talking about for weeks and weeks and weeks, which is the supply chain? The Fed doesn't have the ability to walk into the supply chain and talk to overseas companies and say, hey, get your stuff over here. We need it. They can't do that. They can't control that. But while the supply chain is right-sizing itself and getting back online, which it hasn't yet, but it's getting better, the Fed can control the demand for that limited amount of goods by raising interest rates. You raise interest rates, you make things more expensive, you spend less, you bring down the demand as the supply is coming back up.
Keep going.
So the risk is what? We get all this supply, it finally comes online, and we've raised interest rates and we've hurt demand so much that we go into a recession. And what did the Fed say this week? Jay Powell came out and said, the Fed has to allow some degree of probability of slipping into a recession while we restore price stability. We got to get inflation under control. So if one of the collateral damages is a recession, we have to be willing to accept that. But the Fed believes that they're
That's
going
what the Fed says.
That's what the Fed says.
Yep.
And so by all accounts right now, the economy is still pretty strong. We're talking about corporate earnings. We're going to get a wave of corporate earnings releases in the next couple of weeks, which is probably going to show slowing, right? We talk about the market has already kind of foretold that. It always moves ahead of.
So can I before we move on, let's because I want to clear this up. So the Fed's tightening. I think we explained how their increasing interest rates are going to bring down demand. People are going to buy less stuff because they're going to borrow less money.
Right.
And they're going to want to pay back their debts sooner. So if you're paying down debt, that money is not going to buy something else.
Right.
If you're not taking a loan, you're not buying that car, that blouse, those airline tickets, or that home. You're not starting that business. You're not opening up a new location. Okay, so this is kind of shrinking the economy,
right?
Or at least not growing it as fast. It's not shrinking. That's different, I guess.
Right.
When it is, that's kind of what a recession is.
Right.
Right. So it's disinflation, and so this is a term that we haven't heard. I don't know. When's the last time we should, Google shows you the search, like you look at a word and its popularity. Right. I'd love to look at one of those charts. Maybe we can get that up. Sierra's on the ones and twos looking at it. But if we had that disinflation, like when's the last time people use that word? And it means that the rate of inflation, it's the velocity. It's not going to go up as high. It doesn't mean we have deflation.
Right.
It doesn't mean that inflation's not going to be. It's that instead of 8, we have 6.
Yeah, it's growing, just not as
Instead
fast.
of 8, we have 5. It doesn't mean that inflation's down. It means it's less inflation. It's not growing.
Correct.
So, the velocity of change on inflation.
Right.
Right? That trajectory.
I'm going to say it. The second derivative.
The second derivative. You should. You should. Explain the second derivative. We got 45 minutes. Okay, so that's important. So, and the Fed does the same thing by, unwinding its balance sheet, selling bonds. And when you sell something, you are producing more supply. And when there's more supply, the price goes down, right? It's a whole economics lesson on this podcast.
Right.
Demand goes up, price goes up. Demand goes down, price goes down. Supply goes up, price goes down. Supply goes down, price goes up.
Right.
Another chart we need out there. But I mean, that's really it, And so inflation is you don't have enough supply and you have too much demand. What can the Fed do? We can crank down the demand. And you're saying, what can they not do? Well, they can. They don't have the controls to put together the global supply chain, right? That would produce more goods that would bring down the prices,
right?
And would keep inflation down.
They can only monitor what's going on in the supply chain, but they can't control it.
And so here we have, U.S. consumers, investors, clients, like dealing with these, like, which pain do you like more?
Right.
For some reason, a lot of people can endure the pain of inflation a lot more than they can a recession. And essentially they do the same thing, right? But people look at their money in their bank account and they feel very confident. And even if it gets eroded by 20 or 30% over a few years, they don't see it, right? It's one of the genetic defects we have in our financial DNA.
Right.
A little plug for the Retirement 101 course that we teach. I talk a lot about inflation. But it does the same thing to your money that the market crash does. It just looks different, feels different. And so here we have, like, if I think of the U.S. consumer, go with me on this. Like, you know, they're employed.
Right.
They've gotten some good increases in their wages over the last couple of years. They've gotten some pretty good bailouts from the government, especially those that didn't have a lot of assets or income, right, to kind of help them shore their own credit and balance sheets. If they did and they owned real assets such as real estate, they've seen a significant increase in their net worth over the last couple of years. I mean, everybody essentially is worth more. Not everybody. A lot of people are worth more than they were, say, 2.5 years ago pre-COVID.
Yep.
Even though the market's come down, we're still higher than we were.
With every recession, when we come out of an economic cycle and we come out of a recession, even though it's the low point, it's higher than the last high point.
But so people, what have they been negatively affected by? The only thing negatively infecting people, of course, they're sad when they see their portfolios go down, which doesn't negatively impact you unless you sell.
Right.
It makes you a little sad. Maybe it makes you worry, but it doesn't negatively impact you if you're doing the right thing and you have the right strategy. So that's not really having a negative impact on your life unless you're, betting the money you need in the next 6 months on something that's risky that could go down by 20 or 30%. That's why we would advise not to put that kind of money in the stock market if you need the money soon. So the only thing that's negatively impacting households, U.S. consumers, clients, is inflation.
Right.
And so when we're looking at this Fed and we're looking at the rate hikes and it's causing the markets to go down and we don't like that, but really that's what you're going to need to do, because the only thing that's really negatively impacting you right now seems to be inflation. Is that?
Yeah. And in some respects, it is helping you. We don't, inflation, if you own real estate over time, you're going to move up. Your price is going to appreciate with the rate of inflation. Mm-hmm. So if you have real assets, that's going to help.
Mm-hmm. Yeah, it's interesting. We've seen real estate, certainly here in Southern California, outpace inflation significantly. And, we're probably going to see it, underpace inflation here in the next, this year, probably next.
Let's go back to wages just quickly. You made a good point about wage increases. Mm-hmm. So workers have been getting, there's this great resignation we talked about. People mm-hmm. have been leaving jobs for better paying jobs or deciding to relocate and do, a different lifestyle. But collectively, unions are getting...
Yeah, some of them to go on to make hats and do all kinds of things.
We've got, but people are getting higher paychecks, right? Yeah. And right now, those paychecks are, in real terms, are still a little bit below inflation. So you're getting paid more, but they're not going to, inflation will eventually come under control. Inflation will come down, but your wages aren't going to come down. You're locked in. So at some point, that's going to tip the scales in your favor.
Okay, so let's exactly. So this is temporary. I think it's really important for people to note. We're having inflation. The Fed has these tools that they can use that are going to increase borrowing costs and pay investors to keep money in their bank account versus spending it. So spending comes down. It's going to be some short-term pain, but the inflation run amok is way more painful.
Yes.
And go to the pump and go to the grocery store and say, that sucks. I don't want that. Okay, well, you're going to see your portfolio go down for a little bit. And yeah, there's going to be a recession, but we're at 3.6% unemployment rate. Right. We're healthy. We can handle this. We talked about this before. Hey, we are moving out of our parents' basement, and the Fed is not going to keep just writing checks for doing nothing. It's time to go make something of yourself, and it's some short-term pain, and it's for our long-term success as a country that we go through this period of time. And if we can't go through this period of time, so far so good, really. You're just seeing the markets go down a little bit. The banking system still super strong, housing super strong, the employment rate is high, and so we're getting this inflation down. And yeah, your stock portfolio is down, But so what? It's going to do that all the dang time over the next 5, 10, 15 years. What do you think? It was never going down?
Right.
We see this all the time. I mean, this is about first worst start to 6-month period. I don't want to sugarcoat this. It's been brutal. And you know what? Investors aren't down 20 to 30% on their stocks. They're down 25 to 35. You probably had about 5% inflation so far in the next 6 months.
Yeah.
So look, this is temporary. I think, okay, gosh, do we talk about enough bad stuff? But I mean, if we're going forward, what's on the other side of this is that consumer sentiment is so low. What's the other thing? I mean, when you see what drives corporate profits, and they're going to start reporting this month, right?
Yeah.
So we're going to start to hear about how much companies have likely already, experienced some pain from the consumer demand. And so this is the stuff that just the stock market is such an enigma for most people, because so often, if you look at the direction of the stock market, good news is bad news and bad news is good news.
Right.
Because it's a discounting machine, like you always say. And we're like, well, what's on the other side? What's on the other side? And it's like, well, we need to know that inflation's coming down. We need to know that demand isn't just running amok.
Right.
So when you start to see that come in, like, just wait. And when it turns really quickly. And it could get darker before the dawn, of course. But
and then you'll have that period, we said it before, where the market will start to go up again. And people say, well, why is it going up? And the economy's in really bad shape. Well, because it's that discounting machine.
Yeah. And a lot of listeners out there, if you want to know, like, hey, we get asked all the time, when does it hit the bottom? When are we at a bottom? The day you want to sell your portfolio is likely the day we're at a bottom, right? I mean, that's the capitulation.
Right.
When everyone's ready to throw in the towel, that's when the smart money comes in.
Yeah.
Right? They call it the smart money, the dumb money, right? And you just see it, chasing it on the way up and bailing on the way down. And, we're just not going to do that.
Right.
Right. And so having a long-term investment strategy is important, because what's on the other side is that if demand, let's just say it's coming down. And we know that. I know in my own brain it's coming down. I know how I choose to live my life and how I talk to everybody else that I know that has any clue of what's going on with the world around them, that they're making different decisions on their purchases and the way they think about their savings. If you're I got a $100,000 home remodel I'm thinking about doing. Probably not this year.
Which is what the Fed wanted.
Right. Stop buying so much stuff.
Yeah. Exactly.
You need a little bit of pain. You're getting kicked out of the basement. You need to get your emergency reserves together before you start going and investing in crazy growth companies or just buying stuff.
Right.
So we're going through that cycle. But on the other side of this, inflation starts coming down. Look, when you have the recession or soft landing, hard landing, when people stop buying stuff, then guess what? It goes the other way. Now you got to stimulate the economy.
Right.
And the Fed, I would argue, is likely not going to be able to continue to increase interest rates significantly, certainly kind of beyond this year. Let's just say that's a plausible case.
Right.
So what works well in that environment? I mean, this is where fixed income, treasuries, bonds, might be one of the best performing asset classes on the other side of this.
Yes.
And not only are bonds paying you an interest, you can buy high grade bonds, make 3% from the government. So as long as the U.S. Treasury doesn't go bankrupt, I'm making 3%. But I could also go out to high grade corporates or municipalities. I can make an interest, 3, 4, 5, 6. I can make an interest rate while I'm waiting. And when the Fed reverses course and interest rates come down, the value of that bond goes up.
Yep.
I mean, you look at the 70s and bonds were getting hammered during that inflation when we weren't hiking. And then what happened in the 80s? They were the best performing asset class.
Yeah.
Right when everybody bailed on them.
Because we went from a period of hiking rates to declining, dropping rates. And that was just fuel.
I mean, if you own bonds in the mid 80s, like, you killed it.
And a lot of people didn't in the beginning because they hated bonds because all they did was lose money.
Right. So, I mean, this is just investors, again, short term, what's not working, let's bail. No, that usually means what's going to work. And so those are pretty conservative investments, that you would think about investing in, that you can probably do pretty well. But that's also the recovery of growth stocks, long duration, making money in the future. Those companies should see a kind of a resurgence down the road too. I don't have a crystal ball. You don't either. Everybody should have, consult their wealth manager before making any investment decisions, But, it's shaping up. If interest rates go down, the Fed becomes more accommodative, or they just stop hiking, it's generally
if inflation goes down.
That's because inflation goes down, or we have disinflation.
Right.
And those are typically really good periods of time for longer duration assets like treasuries, fixed income, and growth stocks.
Exactly.
So, look, we have the portfolio during the bear markets. What's going to help you is the opposite of that. As we go through this, where are you going to find the balance? You're going to find it at short duration bonds. You're going to find it at dividend paying stocks. You're going to find it at, low leverage companies, right? And that's kind of where your companies with pricing power. What am I missing? I just recited the list that you gave me, so I don't want to take credit. Or maybe I do. I'm not sure what I'm doing here.
And companies that are commodity based. Right?
Yeah.
Because it does well during inflation. So during periods like this, when interest rates are rising, inflation is rising, and people are less accepting of paying for companies that are going to earn some rate of return way out in the future, they want their money now.
Yeah, it's so challenging, right? I mean, that's just where there's so many ways to go, that having a diversified portfolio, I mean, people really want to just say, hey, what's going to happen? Let's go bet it all there. Like, what happens to commodities, like, in a recession? Like, if you go and buy a bunch of lumber or copper or oil and demand's gone and we're not building stuff.
As soon as inflation turns down we go into a recession, if that's what happens, then those do not work well.
Hang on, right?
Yeah.
Yeah.
You can't make so you're really not diversified. You're making a bet.
Yeah. And so we're gonna have lots of different markets, and I think this is the import of having different strategies in your portfolio and allowing yourself to rebalance, right? Buy the things that aren't working, sell the things that are, selling high and buying low is how you make money. And so that's really the importance of a diversified portfolio. Gosh, how many people just went all in on tech and growth and have experienced the pain? I wonder how many people are going all in on energy right now and kind of doing the same thing on the other side. But
a lot of people, unfortunately.
Yeah. A lot of people are still just crossing their fingers hoping for growth to come back. And it will, right? But these things we're unsure of the duration.
They tend to take longer.
Yeah.
Than you think.
Yeah.
And
so
people lose patience.
If we get inflation under control, that's going to be a good thing for your growth companies. But so you want the more short-term pain, right, to get on the other side of that, because we're not there.
No.
And so you're like, hey, yeah, this is, and so if I'm in it, it's going to keep going. There's some more to go, because until we have inflation, like, that's what's on the other side. So
and higher expected returns on the other side.
So Fed meeting end of July. We have some earnings starting to come out. Right, a lot more next month. But hopefully the back half of this year is better than the first half. Bet you $1 it is.
You're on.
It's not.
I want to pay you that $1.
The last 52 years, the worst start. So, so hopefully
those are good betting odds.
Yeah, pretty good odds. So, all right, hang in there, everybody, and we'll see you back in the next episode of our Presidio Perspective. And thanks for joining us.